Okay, we've completed chapters 1 to 5 so far. Today we're going to start with chapter 6. This continues our discussion about accounting for inventory. Specifically, we're talking about merchandise inventory. The first objective of Chapter 6 is to account for inventory by the FIFO, LIFO, as well as the average or weighted cost method, as it's also known. Okay, FIFO and LIFO are acronyms for first in, first out, and last in, last out. So, on slide 3, we're talking about 4 types of inventory costing methods for merchandise inventory. Specific unit cost, FIFO, LIFO, and the average cost. Okay? Specific unit cost, slide 4, are when units are sold, the specific cost of that unit sold is added to our cost of goods sold. Okay, if you buy a widget for $50, when you sell that widget, that $50, the cost associated with that specific widget, is transferred to the cost of goods sold. Okay, so that's what specific unit cost is. Whatever the unit cost of the item you sold is automatically transferred to the cost of goods sold when we have somebody buy that item. Okay? FIFO is the next slide. Slide 5. First in, first out. That's what FIFO stands for. Okay? What this means is when we sell units of a generic product, the oldest costs are transferred to the cost of goods sold first. The most recent costs stay on the balance sheet in ending inventory. Meaning, if we have made multiple purchases of inventory, under FIFO, we go to the oldest layer of inventory first, move those costs to cost of goods sold as we sell them. The most recent costs remain in the ending inventory. Next slide, we've got an illustration of FIFO. We've got 3 shirts at $10 each in the beginning inventory. We purchased 5 shirts at $12. That's not so unusual. Prices rise all the time. Okay? We then sell 4 of the shirts for $20 each. Which costs of inventory should be assigned to cost of goods sold? Okay? Under first in, first out, we're going to take 3 at $10 and then 1 at $12. Why? We're going into the oldest layer first. Under first in, first out. Then we go to the most recent layer. Okay. So our remaining inventory after the sales is $48. Why? Because we have 4 shirts at $12 each, and our cost of goods sold was 3 shirts at $10 plus 1 at $12 for a total of $42. So moving on to the next slide, we're going to journalize this. Remember, when we have a sale of inventory, we always make 2 journal entries, one for the sale and one for the cost of the inventory. We talked about this a lot back in chapter 5. So don't forget, sale means 2 journal entries. We're going to debit the accounts receivable for $80. That's 4 shirts at $20. Credit the sales revenue for $80. Next, we're going to record the cost of goods sold. We'll debit the cost of goods sold for $42, and we'll credit the inventory for $42. And that's to record the cost of sales. So, moving to our next slide, we've got a simplified income statement. We have sales of $80 less a cost of goods sold of $42, so our gross profit from the sale of those shirts would be $38. Okay, $38. First in, first out, go to the oldest costs of inventory, use those up, and move to the more recent layer. Our next inventory method is last in, first out. This works just the opposite of FIFO. Last in, first out, LIFO, works in reverse of FIFO. The most recent costs of inventory are transferred first to cost of goods sold, followed by the older costs. Okay, so if we purchased inventory today and we sold inventory tomorrow, the most recent cost would go to cost of goods sold. Same basic illustration, but this time we're using last in, first out on slide 10. Same 3 shirts at $10 each. We buy 5 at $12. We sell 4 at $20. The question is, what cost should we assign to cost of goods sold? That would be 4 shirts at $12 each. So last in, first out, we go to the most recent layer. That would be the layer of 5 shirts at $12. We pick out 4 of those times the 12. Our cost of goods sold is $48. What's left in ending inventory are the oldest costs, $42. So journalizing that on slide 11, same initial entry. Debit the accounts receivable for $80, credit the sales revenue for $80 to record the sales on account. Next, we record the cost of the inventory. We debit the cost of goods sold for $48. We credit the inventory for $48 to record the cost of sales. Our simplified income statement, we have our sales of $80 less our cost of goods sold of $48. Our gross profit is $32. So under last in, first out, we take the most recent costs and transfer them to the cost of goods sold as we sell our inventory. So we work from the most recent to the oldest costs. We're working backwards under LIFO. Slide 13. The average cost method is whereby we take all of the inventory costs, add them up, and divide it by the inventory on hand. We add up the total inventory and divide it by the number of units to come up with the average cost. Sticking with our shirt and tie example, we take our beginning inventory of 3 shirts at $10, add the 5 shirts at $12 together. Okay? Under the average cost, what we'll do is we will take our $30 beginning inventory, add our $60 of purchases, and come up with 90 total inventory costs. $90 is our total inventory costs. We then divide that by the number of shirts on hand. 8 shirts divided by 90, we have an average cost per shirt of $11.25. Okay, so if we sold 4 of these shirts for $20 each, the inventory cost of these shirts under the average cost method would be $11.25 times 4, or $45. So we'll debit our accounts receivable, we'll credit our sales for the $80, we'll debit our cost of goods sold for $45, we'll credit our inventory for $45 to record the cost of the sales. What's left in ending inventory is 4 shirts at $45. What was moved to cost of goods sold was 4 shirts at $45. So under the average cost method, our simplified income statement would show our sales of $80 less our cost of goods sold of $45 for a gross profit of $35. So under the average cost method, we take the total cost of inventory and divide it by the number of units to come up with our average cost. That's an overview of specific unit cost, FIFO, first in, first out, LIFO, last in, first out, and the average cost method of pricing inventory.